Standard Life, the Edinburgh-based pensions and savings provider, is one of the most widely owned companies in the FTSE 100 following its demutualisation and listing on the London Stock Exchange in 2006. Since then, its shareholders, most of whom got free shares in the flotation, have seen the share price rise 60%, much better than the 9% rise in the FTSE 100. Things got off to a bad start, but once the financial crisis was over, its shares gathered momentum. Among its rivals, only Prudential has delivered a better return of 78% in the past 7 years. Switch the chart to the past 12 months, however, and it's Standard Life leading the way with an impressive 70% gain in the shares. The company has benefited from a benign stock market and from investors anticipating two big changes in its business. The first is auto-enrolment. This is the government's new policy to get workers who aren't saving into a company pension scheme to join one. Standard Life is a big provider of company pension schemes. It reckons it will attract another 300,000 scheme members over the next 2 years. The second positive change is the abolition of commission in financial services. Standard Life stopped paying commission to financial advisors and other intermediaries years ago. It also built a technology platform to serve the new breed of professional financial advisors expected to thrive in the new era. The best thing about Standard Life for its shareholders is its happy habit of producing good surprises. Its 2012 results smashed expectations with operating profits up 65% to £900 million. Even with one-off items stripped out, underlying profits rose 15%. Best of all, Standard Life increased its dividend by 6.5% and then pulled a special rabbit out of the hat, a £300 million special dividend funded by borrowed money. Dividends are a vital part of the total return investors get from holding shares. The average policyholder in Standard Life got 650 shares in 2006. These have risen in value from £1,500 to nearly £2,500 today. On top of that, they've received dividends of over £600. So the big question is this as good as it gets, or is there more to come? Should you sell or hold on? It's a tricky question because Standard Life shares look expensive. The share price trades at around 14 times the earnings or profits each share is expected to receive this year. This is much more than their rivals on multiples of 11 or 12. The shares yield a dividend income of 4.5%, which is good in absolute terms, but is not impressive among its peers. On the other hand, Standard Life continues to deliver. Its first quarter results for 2013 also trounced expectations, with sales and money under administration beating most analysts' forecasts. The quarterly statement featured a big contribution from Standard Life's fund management arm, which we haven't looked at before. Standard Life Investments manages £179 billion of investors' money. For the first time, more of this came from outside the group than from within. Its secret weapon is its £21 billion Global Absolute Return Strategies Fund. This GARS fund has a reputation for delivering good stock market related returns without the ups and downs of investing in shares. It has hoovered in money from cautious investors around the world, providing over half of the money going into the investment division. There are clouds on Standard Life's horizon, however. In recent months, some analysts have turned negative on the shares, believing them to be expensive. Also, in the new era of transparency brought on by the abolition of commission, there is an argument that Standard Life's profit margins are unsustainable once investors start to see the costs of investing through its products and services. Profits could come under pressure, particularly as its higher margin, older business winds down. So far, though, there is no evidence of this margin pressure, and the best analysts continue to recommend investors hold on or buy the stock. This is a financial company, so its fortunes are linked to the direction of stock markets. A crash would be bad for business. But so far, the consensus of opinion is that while Standard Life has come a long way, its shares have further to go.